Hello, namaskar viewers. I am Sanjeev Pandya welcoming you to this week's edition of the Tax Talk with AJ. The weekly show brings you all the latest that you need to know when it comes to taxes, whether it's personal taxes, corporate taxes, or any form of taxes. We give you all the update in this show courtesy of Science CPS Services, a full-fledged professional accounting firm located in the state of New Jersey, multiple locations, but they can assist you no matter where you are in the state. All you need to do is give them a call at 908-888-8900 or visit their website sciencecpsservices.com. Their knowledgeable, experienced, and on-hand CPAs will assist you in any tax matter. And remember, we're only a few days away for the April 15th deadline taxes. So make sure that you get down to it right away because Science CPS Services believes in doing taxes right. How much refund you get, how much taxes you have to pay, it really doesn't matter. The point is do your taxes right, make sure you get all the deductions that you deserve to get and do your taxes right so that way you are never audited by IRS because IRS tax audit can also be very, very troublesome. And if you are getting IRS notices for tax audit, Science CPS Services can also help you out with IRS tax audit. So with that note, I'd like to welcome Mr. AJ Kumar, CPA and MBA with Science CPS Services for over 25 years. Every week he joins us and gives us all the updates that we need to know. AJ, good to have you. Good to see you.
Thank you, Sanjeev. Thank you for the kind introduction.
You're very welcome. And you look a little relaxed now. Huh?
Just a couple of more weeks, just a few more days to go. I'll be fine.
Maybe less than 15 days or so. Good. Okay. Good to see you a little relaxed because after, seeing him last couple of weeks, very stressed out, working 25 hours a day, but now he's a little more relaxed. All right. So this week's topic is going to be very interesting for viewers who really own businesses or the properties, investment properties, and you're going to find out very useful what we're going to discuss or what AJ is going to talk about, and it has to do with the sales tax. There is a bulk sales tax and there is an exit sales tax. So first, let's talk upon bulk sales tax. As the word suggests bulk, is it really in the bulk?
Well, yes, bulk sales tax and or exit sales tax is a factor of selling an investment property in the state of New Jersey. Most states, not just the state of New Jersey, will have some sort of bulk sales tax or exit tax in place just to avoid for the people not making enough tax payments when it comes to income tax. But take a step back, Sanjeevji. Every week, we talk about one type of tax, sales tax, bulk tax, exit tax, social security tax. But take a step back. When people are talking about taxes, people are talking about IRS, people are talking about the system. Most people are thinking income tax, and that too only federal income tax. You say, what's your income tax bracket? People are asking the federal income tax bracket. People are saying, income tax bracket can be 10% to 37%. But they're forgetting the state income tax. They're forgetting social security tax. They're forgetting Medicare tax. The whole system, when the system talks about taxes, the system is talking about federal income tax only. Take an example, Sanjeevji, please. If a couple is making $200,000, at a federal income tax level, they are at 24% tax bracket, not counting the state income tax of 8% that they have to pay. Then you add social security tax of 6.2% that they have to pay before they get the money. You add 1.45% of Medicare tax on top of it. So 24% of federal tax, 8% of state tax, 6.2% of social security, 1.45% Medicare. Don't forget the sales tax when you buy, not when you receive the money. When you spend the money, you are paying sales tax, 6.625% of sales tax, property tax. New Jersey has the highest property tax. As much as 6 to 8% of your total income goes into property tax. Today, we are talking about the bulk tax, exit tax. You probably haven't even heard of it. If you add all these taxes together, as much as 60% of your income is going into taxes.
Interesting.
How do you win this game? But let's come back to the topic again. Today we are talking about the bulk sales tax, exit sales tax. Let's start with bulk sales tax, as you rightly said, Sanjeev ji. So bulk sales tax kicks in when you are selling an investment property. The concept is, if you sell an investment property, typically the attorneys will let the system, IRS, know that this property was sold for, let's say, $100,000. Now the government knows you sold an investment property for $100,000. So they're counting on getting some taxes. They don't know how much you purchased it for. Only the sales is reported, not the buying. So there is a separate form that the buyers are supposed to fill with the state. And make it a worst example. Let's exaggerate this example. What if this person who is selling this property is moving out of a state? Then how would the state, and let's say New Jersey, would collect the money from somebody who has moved to Florida? That's why they put in exit tax in place. So before you sell, before the seller of the property gets the money, the attorneys are supposed to withhold some money into the escrow account and pay it to the state if the bulk tax is not filed properly.
But that's when somebody is moving out of the state, that's when they let attorney know that they're moving out of the state, and that's when they will have exit tax and escrow and everything. Let's go back to bulk sales tax for a minute. Now, bulk sales tax is for the purchaser and for the seller, both of them. Is there several tax brackets in the bulk sales tax category, or is just a 1% for no matter what kind of property it is? That means could be residential investment property, could be commercial investment property.
Well, it could be any property, residential or commercial. The onus remains on the seller to justify that the seller was living in that house for at least 2 years in the last 5 years to qualify it as a primary residence. But from the system perspective, from the state of New Jersey, for example, perspective, there are only 2 levels. We charge you 8.97% of the gain. And how do you define the gain? The selling price we know, you file a form, the buyer will file C-9600, or the seller will file asset transfer tax declaration form. On this asset transfer tax declaration form, the seller is supposed to say, this is the property I'm selling, this is how much I'm selling it for, this is what I purchased it for, these were the improvements, this is my gain. And the tax is supposed to be either 8.97% of the gain or 2% of the sales price, whichever is higher. That's supposed to go into the escrow account or supposed to be paid to the state as bulk sales tax upfront at the time of sale, which you can claim as an estimated tax payment when you file your New Jersey tax return.
That is for the seller. What about the purchaser?
Well, the buyer is paying the money. The whole system is designed in a way you don't really have to pay taxes when you're buying something. Let's say when you're buying the stocks, do you pay any taxes? When you're buying the digital currency, when you're buying house, when you're buying investment property, typically you don't pay any taxes when you're buying something. The tax factor, the tax kicks in when you're selling something. How much was the gain? How much was the difference between selling price versus the buying price? So sell is what's triggering the tax here, not the buying of the property.
All right. So that is the bulk sales tax. And for anyone selling their investment property, no matter what it is, residential or commercial, I'm sure when they go through the attorney will do all the calculation, everything that has to be paid bulk sales tax.
Yes,
and
so
now we know the
form.
percentage, 8%.
8.97%. So the attorneys will request you, the seller or seller's accountant, to fill up this asset tax transfer declaration form, where you put these numbers in. The seller signs this document or attach these numbers, that these are the real numbers. This is the numbers that I want to use when I file the income tax. We want to remind our viewers, so as much bad as it sounds, the bulk sales tax, this is not an additional tax. This is not something that you are paying in addition to your income tax. This is more of an advance estimated tax payment that you are making to the state of New Jersey, and you can claim this estimated tax payment when you're filing your income tax at the end of the year.
Okay, so now let's say if the property is $50,000 property, they're selling it for $100,000. So they're $50,000 net gain. Now we know a state bulk sales tax, 8.975%. There's a capital gain of $50,000, so federal tax is going to kick in, right? And there is some kind of rule that if you sell the property within 6 months, there is a short-term capital gain, and after 6 months, within 12 months, it would be long-term capital gain.
It's 1 year,
So,
not 6 months. So if you are buying the property and selling the property within 1 year, within, let's say, 365 days, then we consider it as a short-term sale as opposed to long-term sale. But both of these concepts, short-term sale, long-term sale, are a function of IRS, federal government. Here, we are not talking about the IRS. Here, we are not talking about the federal government. We are not talking about the short term or the long term. The bulk sales tax or the exit tax, they are the function of the state.
so whether you keep the property for 1 month or 1 year doesn't really matter.
It wouldn't
You're
matter
going to
to
have
us.
to pay this
Absolutely.
much. Okay. With that note, we're going to go into the break, and when we come back, we're going to have discussion continue on the bulk sales tax and exit tax for you right here in the Tax Talk with AJ. Stay with us. Welcome back to the second half of the Tax Talk with AJ. And in case if you have just joined us, we'd like to welcome you in this show. And you missed some of the information, but we're going to recap it in the second half. But before that, most important thing about Sai CPS Services, a full-fledged professional accounting firm with multiple locations in the state of New Jersey. Now, you know that they can definitely help you out with any tax matters that you have, personal tax matter or corporate tax matter. But the other thing is that Sai CPA Services can also assist you if you are a small business owner and you need virtual CEO, virtual CFO, or someone who can do your bookkeeping and accounting and everything. Sai CPA Services can make it possible for you, so that way you can focus on your business and make sure that your business is successful, and leave everything to Sai CPA Services. Their trained, knowledgeable, and experienced staff will take care of all this thing that you really need to do. On top of that, payroll services also. So keep that in the mind. They can be reached at 908-888-8900 or visit their website, saicpsservices.com. We are going to continue the second half. In the first half, we talked about bulk sales tax, which is for the individuals who have properties, investment properties, residential or commercial properties. And specifically, we are talking about state of New Jersey, that what tax that they have to pay. So we talked about that. Now let's talk about exit tax. Exit tax meaning, what if you decide to leave the state after selling the property? Then what happens?
Well, let's talk about it. So, state of New Jersey can send you a notice which you can choose to ignore. State of New Jersey can put a lien on your local asset in New Jersey, but that doesn't mean anything. The exit tax by definition means you have already moved out of the state. So states can't really do much about it. Once you have moved out, collecting taxes from somebody, especially if you are retired and you move to Florida, what can the state do? They can keep following up, they can keep pushing their luck, but it's not going to result into anything. And that's why they had to enact this exit tax. So when you move out, at the time of selling the property, they will collect enough taxes from you. If you choose not to file the taxes after moving out, your problem. We don't care. Take an example. We had a client, he bought a house for $250,000. After several years, he sold it for, let's say, $400,000 in this example. Their gain was $150,000. The state collected $14,000 at the time of sale before the closing. At that time of closing, the state said you have to hold $14,000 and send it to the state. Now, the state got $14,000 upfront at the time of closing. If this client, if this person chooses not to file New Jersey tax, New Jersey doesn't care. If they file New Jersey tax, they can claim that this is the income, this is my W-2, this is my income, this is my losses, and I have already paid $14,000 as advance tax for this transaction. If they owe more money, they can pay more money. If they don't owe anything, they can get a refund. Let's say hypothetically they did not owe anything. They have the right to get the refund for the bulk sales tax or the exit tax that they paid in advance. But the rule is, the rationale here is, the theory is, when you're selling the property at the time of closing, whatever the perceived gain is, the state will charge certain taxes on this gain upfront at the time of closing.
You know, this exit tax sounds a little bit complicated here, because let's say once somebody sells the property, they're paying bulk sales tax and all the other things, whatever they need to pay. Now, at the same time, if they're moving out, they need to let attorney and accountant know that we're moving out of the state and there is an exit tax. My question to you is, what's really purpose of exit tax? They are moving out of the state. Why do they need to collect exit tax on top of the sales tax, bulk sales tax?
You are 100% right, and we should have clarified it for our viewers. Bulk sales tax and or exit tax, they are one type of tax. Not both will apply to you. So bulk sales tax applies to you when you are selling an investment property and going to stay within the state. The tax is referred as the bulk sales tax, selling the property, but I'm still around, I'm still responsible for my taxes. Exit tax, the same transaction, same type of tax is referred as exit tax when somebody is selling the property and moving out of the state. They're not two taxes. They're not that bulk sales tax is there and now I have to pay exit sales tax on top of bulk sales tax.
Okay, so on the form that you file, I don't know, you mentioned C9600 or 9800.
That's for the buyer. C9600 is a buyer's declaration.
And the seller's form?
Seller will file asset transfer tax declaration.
Okay, fine. Is there a column, is there a question on that form that, please answer if you're going to be moving out of the state, yes or no?
Well, no, it says where is going to be the next address, where is going to be the future address for you. And if that future address is New Jersey, then it's bulk sales tax. If the future address is out of New Jersey, the same schema, same tax plan is referred as exit sales tax, that you're moving out of the state. But again, these are not additional taxes. First, bulk sales tax and exit sales tax, they're not two different type of taxes. One tax, depending on your situation, either is referred as bulk sales tax or exit sales tax.
Okay.
Second, this is not an additional tax. This is an estimated tax payment that's just paid at the time of closing, at the time of selling the property, which you have the right to show on your income tax return when you're filing the income taxes at the end of the year.
Okay. Then any other question, just for my curiosity. This bulk sales tax, I can understand, but the exit tax, which is tagged along with the bulk sales tax, is it only in state of New Jersey or all the states in U.S. or certain states in U.S.?
Well, most states have some sort of mechanism. They call it with different names, but every single state wants to have some sort of system around to make sure people are not misusing the state income tax scenario. So whenever somebody is trying to move out of the state, at the time of closing, at the time of selling their final asset, selling their property, the state will have something in place to claim certain advance taxes. In some cases, it's called exit tax. In some states, it's called transfer tax. In some states, it will call the investment tax. So the name could be different, but most states have some sort of system in place to collect some advanced taxes around it.
Okay, that is very interesting, folks. Exit tax that we are talking about, that, if you're leaving the state that you live in, this is specifically for New Jersey, that if you're leaving the state and, you have sold the property, then bulk sales tax and exit tax comes in together. So there is no way you can minimize exit tax based upon your income or taxes filed or nothing like that. It's just a one simple calculation which goes along just like bulk sales tax.
Well, it's your declaration. And since it's an estimated tax payment, there is no reason for you to be trying to minimize it, meaning you pay now, you pay later, you have to pay anyway. But what you could do, let's say if you want to minimize the estimated tax payment, you can add up the improvements that you did in that property. Let's say you bought the property for $100,000, but you had to change the roof, you had to change the flooring, you had to change the bathroom, you invested $50,000. And even though you sold the property for $160,000, you don't have to say the gain is 60. I bought it for 100, selling it for 160. You say the gain is only 10,000 because I invested $50,000 into this property before I could sell it. Okay. So in that way, the exit tax is computed based on 10,000, not on 60,000.
All right. So knowingly or unknowingly, let's say unknowingly in this case, give them a benefit of doubt that they leave the state and they are not aware of this situation and whatnot. What's the worst thing could happen, especially with the exit tax? Are there penalties? Are there fines?
Well, no, take a step back. exit taxes are already paid at the time of closing
As a part of bulk sales tax.
as a part of the closing, right? Now, if you forgot, if you moved and you did not file the taxes in the state of New Jersey, for example, then the worst is you lost some money. You gave some estimated taxes, which you could have collected back at least partly. By not filing the taxes, you did not collect some money that you had the right to.
Yep.
So the worst case scenario, you paid some money to somebody that you could have called back, you could have taken back at least part of it, which you did not.
Okay, so that is the exit tax. Do state pay anything to say like a welcome package if somebody moves in the state of New Jersey?
Yes, you wish, right, absolutely. Well, kidding aside, but there are certain states, especially the states where the population is not that high, they have this first time home buyer advantage. They have this don't pay any taxes for our state for n number of years. They have property taxes are very low. So there are some direct and or indirect incentive, quote unquote, welcome package in many states, but there is nothing like exit tax. There's nothing as opposite of exit tax.
Well, that's going to be your homework. When you find out those states, do let me know so we can let our viewers know also. Just for curiosity package, that what would be their welcome package when you move into the state? Because when you exit, you have to pay all the taxes and everything, work out everything. But when you move in, there should be a nice welcome package, anywhere from a couple of $1,000s to a huge break in the taxes. I know they do it to many companies, many businesses.
Yes, absolutely.
When you move into a certain state, they give you a big break. Anyway, folks, in this show, the Tax Talk with AJ, we give you a break in the sense of we get you all the latest that you really need to know when it comes to taxes, because taxes can be complicated. And while the show is going into the production and everything, we're going to be maybe less than 10 days away for the tax deadline. Remember, it's April 15th. There is no extra day in this year. So April 15th is the tax deadline. Make sure you file your taxes. And even if you're not ready for it, that's okay. Just call AJ at Science CPA Services and file an extension. Please do that, because taxes are inevitable and you have to pay the taxes. Once again, Science CPA Services can really assist you in all your taxes and accounting matters, and they can really solve your problem. Do give them a call if you're looking for a good accountant, professional accountant who can do your taxes right. 908-888-8900 is their phone number, and Science CPA Services is their website. AJ, anything else you'd like to add in the end?
Yes, absolutely. Thank you, Sanjeevji. So please file your taxes sooner, as soon as you can. For any reason, if you cannot file your taxes, please consider filing an extension. And remember, extension is for filing only. If you owe money, you're supposed to pay by April 15th. Extension does not give you more time to pay, more time to make the payment. So please make sure you file the extension, at least if not the taxes, and make an estimated tax payment if you expect to owe money.
Very good. Thank you so very much, AJ, for your time and for your participation in the show. I am Sanjeev Pandya. Until we meet again, same place, same time, wishing you all happy and tax-free days ahead. So long.
Thank you.